All right, Matt Orton is joining us, Head of Advisory Solutions and Market Strategy and Chief Market Strategist at Raymond James Investment Management. Matt, great to speak with you as always. Let's start with China because I think that's the big story that everyone's looking for globally. What did you make of the announcements which came in from their finance ministry over the weekend?
Good morning. Great to see you as always. And it was disappointing. I've long been a little bit skeptical on the Chinese growth story, and I think the news that we got over the weekend is just a little bit of more of the same, which is a lack of clarity. And I think what the market really needs at this point is clarity with respect to how big the fiscal stimulus is going to be. And more importantly, is China willing to run a larger fiscal deficit than what they have traditionally adhered to, which is around a 3% fiscal deficit? In order to dig themselves out of this significant savings consumption imbalance that they have, we're going to need something more on the tune of 5+% of a fiscal deficit, and we're just not getting it. So I think the market's very uncertain what to make of this. And so I think that's why you're seeing a little bit of uncertainty with respect to Chinese equities.
Matt, let's talk about your investments, and I want to start by talking about China. Are your investments in China driven by short-term tactical opportunities based on current market conditions and the stimulus that's expected from the Chinese government, or are your positions a lot more long-term structural in nature, with regard to China's outlook on the economy?
Yeah, that's a really good question. And I squarely put China in trade bucket. China is a short-term trade, whereas markets that I think have long-term, very strong, robust fundamentals with secular growth trends like India, like the United States, those are long-term investments. And so I, number one, remind clients when I talk to them about all of the buzz that's around China is it's okay to trade China, perhaps use options, think of ways that you can get involved without having to take too much risk, because the market's going to be very volatile. But instead, think about also how maybe you can get tangential China exposure. Perhaps global growth enthusiasm can be represented by leaning more into cyclicality, whether that's in the US or miners around the rest of the world. So there's other ways you can get exposure to the optimism around China without having to make a direct bet in the Chinese equity markets, which we've seen over the past week or so, can be incredibly volatile. So it's definitely a trade, not a long-term investment.
Matt, the question there, but though is, have you observed in the recent past any kind of large reallocation moves? And even if that would have happened, because a lot of people are saying that there has not been substantial reallocation, but even if that would have happened, are we coming to the end of that kind of a move, reallocation of money away from other EMs to China?
I think we're coming to the end of that. I think we've seen a substantial trade-off between India and China. I mean, you look at the FII numbers coming out of India over the past 2 weeks, and it's been pretty relentless. But I think foreign investors have gotten a little bit over their skis with respect to China. It's a story of being underweight to China, very, very underweight to emerging markets, more broadly speaking. And as a result of that, they're playing catch up. They're trying to find any areas they can take cash from, reallocate it to another emerging market. But I don't really think those are long-term dollars that are in movement. And I think the fast money nature of the rally we have in China is on display, just with how volatile the market has been. So I would expect once this Chinese enthusiasm has kind of lulled, if we don't get the type of fiscal stimulus we're expecting, I would think investors are going to start to put some of that money back to work in those longer term fundamental stories, whether that's India, whether it's moving more cash on the sidelines into some more fairly valued pockets of the US equity markets. I think we're going to start to see that rebalance, especially as we head into the end of the year, and investors are becoming a lot more risk conscious with respect to locking in performance for a very, very good year. Their willingness to take on outsized bets or outsized risk is going to decline. So I'm waiting to start to see signs of that sort of rebalance of fund flows, or at least a cessation of the money moving into China. And I think that's the time to really start to add more money into some of those longer term fundamental plays.
Matt, trying to understand how you were looking at the US elections, just about a little over 3 weeks now left to go for that big decision. It's still neck to neck. I think the latest polls are showing Trump slightly ahead. Are you seeing this as a big impact factor?
It's certainly on the minds of every investor. And I get asked by clients probably every single day at this point, how should I invest? How should I position based on who I think is going to win? And the one reminder I give to them is don't. Just don't try to make those bets. When you go back historically speaking and look at every single bet that should have been a surefire investment based on who we thought was going to win an election or based on what we thought the regulatory agenda was going to be, it rarely, if ever, plays out that way. So instead, what I try and encourage clients to look at are what are some of the bipartisan issues that both of the candidates are talking about. So part of that's tariffs on China. So I think that naturally makes me a little bit more skeptical about some of the enthusiasm around China. But other bipartisan investment ideas is the concept of reshoring, bringing manufacturing back to the US. I think that's a long-term durable theme, the build out of more electric utilities to help support the future of AI, whatever that looks like. So I think those are areas that I feel much more confident putting money to work because we're seeing an inflection in the earnings profiles of those companies, and they're still relatively cheap compared to the rest of the S&P 500 and US equity markets. So there's still a ton of opportunities, and you don't need to play the US election in order to get exposure to that.
Matt, let's move focus to India now. And the reason I ask is because you did point out that in view of the recent correction and valuations easing off in the last couple of weeks, you do like some areas in the Indian equity market. So any specific stocks or sectors that you're bullish on? And also give us reasons for why you favor these companies and what factors you believe could drive these counters higher.
Yeah, so India has been my largest overweight outside of the US from a global investment perspective for a long time, and it still remains that case. And I think within India, quality continues to matter. I think investing in quality companies where you can have confidence in their earnings profiles going forward is on display, even with respect to this correction. You've seen some higher quality companies that I like a lot, like ICICI Bank, which has exposure to really just a broad consumer demographic, but also it has exposure to private investments, greenfield financing, as well as a large private wealth management businesses that continues to grow. And it's printing mid to upper teen double-digit EPS growth. So that's a great steady compounder. So when a name like that pulls back, that's a great time to be putting money to work. The pullback we had earlier in the summer in another high-quality grower like M&M, Mahindra & Mahindra, that to me is also an exciting opportunity because you have great long-term secular growth profiles. You don't just have exposure to their auto and farm implements business, which are doing quite well, and the enthusiasm around rocks is really, really exciting. But you also get exposure to the Indian growth infrastructure theme through all of the other Mahindra Group companies through that. So that's another really, really good, I think, long-term investment play. And I think IT services as well is another sign that this pullback in India is certainly viable because you're seeing strength in some of the names that have more exposure to the global economy. So whether that be an Infosys, for example, that's also, I think, a signal that this general pullback we're seeing is definitely an opportunity to think about putting money to work into higher quality companies going forward.